Good morning, Troy Wirth, Wirth Financial. Today in our talk, we're going to talk about life settlements. And life settlements are basically the legal sale of an existing insurance policy, typically a universal life policy. It could be term, but the sale of that policy to an institution for more than what the cash value of that policy would be. Now, there are, of course, a number of reasons why a person may want to sell a policy, whether they're going to get rid of it anyway, that perhaps they've purchased a policy in the past for a reason, for a business reason, and they don't own the business anymore. Perhaps beneficiaries have passed away. Perhaps their balance sheet is such that they don't need to have additional death benefit. And so that is really what a life insurance settlement is. And there's also maybe obliquely related to that is what's called a viatical settlement. And that would be, a viatical settlement would be the sale of an insurance policy where the insured is actually terminally ill, where they would have 2 years or less to live. So that's kind of the backdrop for our conversation today. And I'm joined with content expert Lisa Rehburg of Rehburg Life Settlements. Good morning, Lisa.
Hi, Troy. Thanks for having me. Pleasure to be here.
So I wanted to kind of provide that backdrop because I think there's a lot of confusion about it. And just to touch for 1 minute on just one piece, there's also this thing called STOLI. I think in the marketplace or in the world, sometimes people hear about selling life insurance policies and things, and they hear about this stranger-owned life insurance. And those types of policies, it's actually not a legal transaction. So I want to touch on it just for a minute and really focus on the core piece of it, which isn't people that are already terminally ill, which probably should keep their policy as it is, if to every extent possible, only in an act of desperation or to keep them alive because they needed the money. But really, the life settlement is the primary element that we want to cover, not this sort of more nefarious part of the market of the stranger-owned or stranger-initiated. So let's get into the life settlement. If you could, in your own words, even just describe this, because you are, as a content expert for this discussion, your business is really facilitating and helping what are primarily senior citizens who are in this position that they've approached you. They have a policy that they don't want or need, and they've discovered that that they can actually get more money for it than what the cash value might be minimal in the contract, but the policy may have a higher value. So just to, maybe in your own words, describe the life settlement market, if you would.
Well, you did a perfect job of it, Troy. As you said, it's a financial transaction. That's it. So if people think about their life insurance policies like a house, we're kind of like real estate agents for life insurance policies, right? There's very few of us in the country. So I'm so privileged to be here. I feel so privileged because it's all about raising visibility that this option exists. And yes, it's legal since 1911. And yes, it's highly regulated by departments of insurance across the country. So this is a true financial market. This is about selling an asset, like you said, that people don't know they have. And 500,000 seniors a year will lapse their life insurance policies, meaning that, like you said, they don't want it, they don't need it, maybe the premiums don't fit in the budget anymore, whatever it is, they just don't want it, and they just drop it. And I call it throwing it in the trash. They just let it go because they don't know that there's another option, and we certainly are that other option. So selling the policy for cash is a wonderful thing if you're going to walk away from a policy and let it go.
Yeah, so what you're really talking about is for a senior citizen, hopefully to the extent that they see this or that they have an advisor who advises them that this asset has value, it's really more of a fact-finding mission to find out, is it appropriate, is there a market, and to what extent it is, and is it worth the process?
Well, that's exactly it. And the beautiful thing also about life settlements is when we do our work, and by the way, this is a 3 to 5 month process. This is not something that happens in 3 to 5 hours or 3 to 5 days. But to do this right and to market a policy right, it does take that long. It takes us about 60 to 90 days to find out from investors if they're willing to make offers on policies. But the beautiful thing is even if an investor makes an offer, the client is not obligated to take it. So that is a great thing too. I call it free, no obligation appraisals to find out. If someone's considering lapsing or surrendering their policy, please look into a life insurance settlement because it may be a better option for you. It may not be. But if it's a term policy, certainly anything we can get is a bonus, right? Term has no inherent value. If it's a universal life or a whole life that has cash value, on average, and we know how averages are, but on average, a life settlement will garner 3 to 5 times cash surrender value. So that's a big thing. We're working with a lot of clients right now that have that cash surrender value, and they're just trying to figure out, Lisa, which way is the best option for me? Should I just surrender the policy, or will I get more money through a life settlement? And like I said, no obligation to find out.
Well, and this is frankly one of the reasons why I wanted to have you be on our program, is that you act in a, so to speak, brokerage type capacity where you have relationships or contacts with a host of different firms that essentially package these policies that are essentially an investment process. So, I guess for a minute, just talk about your value proposition to a person who is looking at this, going directly to an investment company that may have contacted them versus, utilizing your services.
Right, I appreciate that. So you're right. There's 2 ways to do this. Clients can market their policies themselves, but most clients don't know the investor groups that are out there. There is one prominent one who's doing a really good job of advertising. I fully appreciate the fact they're advertising because they're at least raising visibility for what we do, right? But the difference is when a client calls the 800 number on TV, that investor group, no disrespect, we work with them. They're huge. I like them a lot. They're buying a couple of our policies right now. But point is when they call the 800 number, that investor group does not represent the client. They're trying to get the policy as inexpensively as possible. We are just the opposite. We're on team client here. Our job is to represent the client, to market their policy, like you said, to multiple investor groups. We have access to about 30 of them, and basically run up the bill for the investors. Our job is to maximize the amount of money that we get for clients. And I'll give you an example. And this is a recent client, but I'm going to qualify this by saying every client's different, right? Please don't think this happens every single time. But we've got a $250,000 term policy that we sold. The opening offer on its policy was $15,000. By the time we were done, it was $128,500.
Wow.
So my point is we do earn a commission for that. So if someone goes directly to an investor group, they don't have to pay commission, right? Understand. But the value that we provide is to be able to maximize that value for the client's policy. That particular client was thrilled to pieces to pay a commission because it's like, great, because had he not known about us, he very well might have sold his policy for $15,000. I mean, how does he know the difference? How does he know what it's worth? He doesn't. So when you use a broker, you find out what the maximum value for your policy is.
Right. Well, I mean, that's obviously, and that's why I wanted to focus on that just for a moment. It's not just like it's a market. Utilizing a broker is definitely it sounds, to the consumer's advantage because you're advocating for them. You're representing the client to the purchasers. So talk a little bit about, kind of what's the process. Let's just say someone has a policy, they find out about this, and they come to you and they say, how do I do this? What's the process?
Right. So it's pretty simple. There's an application. The application is about 10 to 12 pages long, depending upon the state. And I always tell people, don't freak out when you see it. A lot of that is going to be legal disclosures. Remember I told you we're highly regulated by departments of insurance? Legal disclosures the departments of insurance make us put in there that clients need to sign off on, like please consult with your financial advisors. You understand you're looking into selling your policy, that your beneficiaries, won't get any money from the policy, those types of things. There's also what we call a HIPAA sign off that allows us to get medical records. And I'll explain that in a minute. And there's also a life insurance sign off so that we can talk to the life insurance companies. Most of that application probably takes 15, 20 minutes. Most of the application really is about the life insurance policy, how long have you had it, when was it issued, who's the beneficiary, those types of things. And I also ask separately a medical questionnaire. That's not mandatory, but there's a reason for that. It's about 2 pages, so 15, 20 minutes of time from the client's perspective. We have to get medical records. Why? Because the investor groups have to underwrite, if you will, and analyze. Because what they're looking at is how much premium are they going to have to pay, because they're going to take over, right? As the owner of the policy, they're going to pay the premium. They're going to be the beneficiary. So they're going to look at how much premium do they have to pay, which is why we need that life insurance release form so we can talk to the life insurance company to get projections. The other big component is they have to underwrite someone's life expectancy. How long are they going to have to pay these premiums? They're typically looking for 10 to 15 years of life expectancy, maybe 20. There's some pension funds out there that don't mind the longer life expectancies, which is a good thing. But the point is we need to get the medical records, because that is how they evaluate and underwrite what someone's life expectancy is. So to be clear, clients fill out the application, the medical history. They don't need to go to the doctor. They don't need to obtain medical records. We do all that. They don't need to get what we call parameds or blood work or none of that. So when we get all that data, we package it up with a pre-read bow, if you will, and we send it out to investor groups and let them start bidding. And the beautiful thing is if we have 2 or 3 investor groups who are interested, that is a wonderful thing for a client. But point is, we get offers. The client can say, yes, I want it. No, I don't. So it's going to take us about 60 to 90 days, typically, sometimes a little shorter, sometimes a little longer, to obtain all those medical records and get it out to the investors. They need about 30 to 45 days for their review. Some of them are a little faster than others. So typically 60 to 90 days. And we receive offers or not, right? If we don't receive offers, at least the client knows that they're going to drop the policy or surrender the policy, that's going to be a better option for them. If we do receive offers and the client says, yes, I want to go ahead, then we're probably looking about another 60 days by the time contracts are signed. Once again, think real estate, big contract, signatures, notarized signatures, documentation. And then we even go into escrow, just like a real estate transaction, because when the paperwork is sent into the company, to the carrier, insurance company, to change over everything to the investor group, that happens in escrow. So if something happens to the client, the policy is still intact and the client's beneficiaries are taken care of. I mean, only when we're all the way through it, everything's been changed over, escrow will close and the money will be sent to the client. So long answer for 3 to 5 months typically.
Yeah. Well, I think it's valuable for our viewers to know that essentially that they've gone through a process to make an informed decision. I mean, that at the end of the day, that's, if they're living in a silo and they just don't know about this stuff, they cancel the policy, that's one thing. But to the extent that they know, then they can obviously just as they wouldn't sell their home for a dramatic discount to the first person that walks up and knocks on their door if it's not for sale. The same thing holds true. You market and find that out. So that's obviously an important aspect to what you're talking about. I think it's important to, at least from my perspective, I mean, being in the insurance business and being an agent for like 23 years, you want to protect your clients, right, and make sure that they're in good stead. So, and you mentioned the regulations and the disclosures and the HIPAA authorizations. I assume that there's a firewall there between sort of personal information and then the ultimate end. The end purchaser of the policy. So there's anonymity in this whole process.
That's correct. Yeah, there has to be. Absolutely.
Yeah. And that's, I was reading, again, a little bit more as we were talking about doing this. And it was interesting that it was actually case law from like 1911. That was a case law that went to the Supreme Court that said, look, it's okay for a person who owns a life insurance policy to sell it, which is not what you're going to probably hear. The insurance companies, and they're a big lobby and they've got a tremendous amount of power, especially their collective voice. And they're powerful institutions that are very strong institutions. And so to have that case law come down, in 1911 says a lot about the validity of the market, and that this is not just some harebrained idea that's just kind of come out of nowhere as a process, as we have this aging America that we live with.
Yeah, that's exactly right. And it was Justice Oliver Wendell Holmes who wrote the statement of decision on that one, right? That
Yes.
guy. So very prominent. But the point is that it makes it legal here in the U.S. Canada, maybe not so much. So, we're very fortunate here in the U.S. to have that statement of decision. And at some point in time, Troy, if you're ever interested in the backstory on Grigsby versus Russell, which is that Supreme Court case, I'm an insurance geek, so I love the backstory, but now your listeners probably don't want to hear it. So we'll table that. But the point is that, yeah, I can transfer my life insurance policy to you today, right now, with a change of ownership form. Like, don't tell my husband, but I can. And we can do that because of thanks to Justice Oliver Wendell Holmes and Grigsby versus Russell. All we're doing is transferring ownership of an asset. Once again, think real estate. When I sell my house, I'm transferring ownership of my asset in exchange for cash, in exchange for money, to somebody else. It's exactly the same thing.
Yeah. Well, I think it's comforting, and it gives credence to the process of actually, taking it seriously for people who, again, there's many different people who may have an insurance policy. Maybe they do or don't need the money, but the people that do need the money probably really do need it, because, with longevity, with sort of long-term care needs and things of that sort. I mean, that's not a thing that a lot of people really probably adequately plan for, especially with the cost. You spend $60,000 to $100,000 plus a year for long-term care. You get to a certain point where you're going, gosh, do I want to have my insurance policy, or do I want to live in comfort, for my last years of life? And I think you touched on the point, maybe to talk a little bit more just about that there's disclosure too to the beneficiaries, because obviously we live in a litigious world, and you could have a beneficiary coming out after the fact, maybe complaining or arguing the point that I didn't know about this. So maybe you can talk a little bit about that, because I think that's an important point that I was not aware of.
Yeah, so it's very transparent, right? And the beneficiaries do need to sign off, because once again, back to your point, we don't want mom or dad to pass away and the kids going, hey, where's that $500,000, life insurance policy that mom or dad told us about 10 years ago. And it turns out mom or dad sold the policy 5 years ago. So it's really important the beneficiaries sign off on it. Everybody's on board. None of this happens under the table. And the other thing that's important as well is many of the investor groups, I will say most of them, will require a doctor's letter. It's already pre-populated, but a doctor's letter that the owner of the policy is of sound mind to be able to complete this transaction, that they do understand what they're doing. So like I said, a lot of legal disclosures, a lot of transparency, and that is very important. No one is surprised. Everybody knows. And I will tell you this, that you mentioned the highly litigious society. In the life settlements market, in the last 8 years, there's been 2 complaints about life settlements. One is about an insurance company who was dragging their feet and, obviously can't. And the other one was about someone who wasn't licensed properly, and they, got licensed and they're fine. So my point is, because it's so transparent, we don't see issues with people saying, hey, I didn't know, or beneficiaries coming out, or any of that. It doesn't happen in this market, and that is a great thing as well. That means the market is operating well.
Well, and it's a testament to the fact that the regulations are there and that they're functioning properly. So that's a good thing. I guess the other question that I had, just as a matter of curiosity, who's investing on the other side of this? who's investing, why would they be investing in it? Just, I mean, not as a financial advisor, and you and I both, we're not CPAs and we're not attorneys, so people need to consult their own professionals to engage in these transactions, are obviously highly recommended to do so. But who is investing in these settlement policies?
Yeah, so good question. I have clients ask all the time, like, who's buying my policy, Lisa? This is not your next door neighbor, and I think that's really important. This is big institutional money, and what I mean by that is Warren Buffett has been investing in these since the mid 90s. Blackstone Group, hedge funds, pension funds, mutual funds, college endowment funds, other insurance companies who don't want you to know they're doing this. You're never going to see their name on the paper on the contract, but they're going to be the money behind it. And the reason they're doing it is twofold. One is the returns. Returns aren't too bad, right? And the returns are paid out by some of the biggest, strongest institutions in the world, life insurance companies. So the investment is going to pay off, right? Going to happen. It's just a function of when. But the other reason they do it is for diversification. So meaning that it's this particular asset class, if you will, is not tied to anything going on in the world, is it? It's not tied to the stock market. It's not tied to the price of oil. It's not tied to world events. It's tied to nothing. So they're doing it as a diversification tool. They're taking a small slice of their portfolio, investing it in life settlements, and it works out well for everybody. The client receives cash from an asset they didn't want, didn't know they had. That's a great thing. The investors receive their money. So it's a twofold symbiotic market and symbiotic relationship, if you will.
Yeah, well, I think it's an interesting thing. I think it might raise an eyebrow or two just to know who, that there are substantial investment groups that are investing in these. Obviously, that's not a cornerstone of their investment. It's a way that they're diversifying through, their modern portfolio theory or whatever their investment strategies are, that they have a non-correlated asset, as you mentioned. So, well, I want to thank you for being with us today. It's been very educational and insightful, and it's always delightful to see you. So I thank you for coming on and being a part of the show.
It's a pleasure. Thanks a lot, Troy. Appreciate it.
All right. Well, until next time, be well, stay cool out in the desert, and we will see you again.
Sounds good.